We're a little bit more than 2 hours away, less than 2 hours away from the second quarter GDP data scheduled to be released at 8:30 a.m. Eastern. According to economists surveyed by Bloomberg, the U.S. economy probably shrank at a slower pace in the second quarter, a sign that the worst recession in half a century is winding down. John Silva is chief economist at Wells Fargo Securities. He says that while recession appears to be ending, the economy is not out of the woods just yet. John is joining us this morning from Charlotte, North Carolina. John, always glad to have you on. Second quarter GDP data, the most important element is the balance of inventory versus final sales, is it not?
Yeah, that's the internal dynamic we're looking for. Is the demand for the economy rising, whereas the inventory gains are shrinking? We don't want a lot of inventory gains. That simply says these are unintended, whereas the final sales number, basically the old classic undergraduate economics, C plus I plus G, seems to be picking up, and that's what we're seeing.
John, do you think we're going to see real GDP growth in the second, or rather the third or fourth quarters?
Yeah, we are going to see real GDP growth, Deidre, but again, as you and I have talked before, the balance is going to be quite different than the typical economic recovery. It's really going to be driven by the stimulus program, government spending, and the private sector, the old C plus I, consumer plus investment spending, still going to lag.
It's a little bit early maybe, or completely premature anyway, to talk about a second stimulus package. What is the likelihood of one coming in?
I think it's very unlikely, because by the time the third and fourth quarter data are reported, it's going to be pretty clear we're in an economic recovery. And so we don't need a counter-cyclical fiscal policy. What we really need is the Fed to gradually exit, for the long-run fiscal balance of the U.S. become a focus. And I think the private economy can take care of itself on those conditions.
John, Eric Schatzker here. Quick question. Going back to today's data, where should we be focused? Where might we see surprises? Where do we need to drill down a bit further? And do you have any thoughts on where we might see some important revisions?
Well, I think one of the surprises may be the consumer, that the consumer spending numbers are a little bit stronger than what people had expected, and that may actually give us a less of a negative GDP number and a little bit more upward momentum. I think the second surprise, or the key element here, is that continued low inflation. We are getting, again, some economic growth, some demand, but surprisingly the inflation numbers still remain remarkably low.
John, we talked about the consumer just now. Of course, the biggest element to the consumer is whether or not that person has a job. You're still looking for unemployment to top out around 10.5%. I've heard some estimates going as high as 11% now.
Yeah, I think, Deidre, that's what makes this economic recovery so different than what we're seeing in the past. I think when you look at the second half of this year, consumer spending still far below what we would typically see, and the economy's recovery really driven by government spending and the turnaround in exports.
What is the one sign, John, of course there's probably more than one, that you're looking for to tell you that the U.S. economy has in fact stabilized, it's out of the woods, so to speak?
Yeah, I would say, again, when we look at next week's numbers, look at the Institute for Supply Management survey. If that continues to improve, move towards 50, that would be my leading indicator that the economy really has stabilized.
As an economist, this is a larger sort of macro question. Are you comfortable with what you've heard so far from the Fed about its exit strategy?
Yeah, I am very comfortable with that, Deidre. I think the emphasis for the Fed is correct in terms of moving away from some of these instruments. But there are two key points, Deidre. One, does the Fed actually have the will to implement that exit strategy? And then second, to recognize, especially in the financial markets, as the Fed exits from treasuries, asset-backed securities, mortgage-backed securities, the pricing on those securities is going to change. And is the market ready for that kind of change? And is the administration willing to allow mortgage rates to drift up in response to that exit strategy?
John, we thank you as always for joining us.
Thank you, Deidre.
John Silva, chief economist from Wells Fargo Securities.